Inventory, profit, and loss is Unit 6 of the course Business Mathematics or BM501. Objective number 1, calculate the inventory balance. So these are the keywords that we need to understand. Beginning inventory is the value of all goods at the start of a particular period. Purchases refer to additional goods bought to be used or sold. Available goods refer to goods available for sale or used during a particular period. Cost of goods sold refers to the value of goods sold, and ending inventory refers to the value of the remaining goods at the end of a particular period. Example number 1. On March 1, the beginning inventory of M&O Merchandising Company was $89,346.26. The purchases made during the month amounted to $36,828.93, and the cost of goods sold during the month was $72,371.07. And the question is, determine the available goods for sale and the ending inventory for March. So this is our solution. For the available goods for sale, it's equal to the beginning inventory plus the purchases. So we have here the beginning inventory, 89,346.26, and the purchases is 36,828.93. So the sum of these two amounts is $126,175.19. For the ending inventory, this is our formula. Available goods for sale minus cost of goods sold. So we have available goods for sale, this amount, and then cost of goods sold is this amount. So we are going to subtract 126,175.19 minus 72,371.07, that is equal to $53,804.12. So this is the ending inventory for March. Example number 2. The beginning inventory of PQR Supermarket on April 1 was $802,128.39. The purchases made during the month was 40% of the beginning inventory. The ending inventory was $789,326.08. Determine the available goods for sale and the cost of goods sold in the month of April. So this is our formula. For the available goods for sale, it's the beginning inventory plus the purchases. So our beginning inventory here is 802,128.39, and the purchases is 40% of the beginning inventory. So that means 802,128.39 times 0.40. So adding the amount obtained here and the amount 802,128.39, this is the sum, $1,122,979.75. For cost of goods sold, the formula is available goods for sale minus ending inventory. So this is our available goods for sale, 1,122,979.75, and we have here the ending inventory, 789,326.08, and the difference is 333,653.67, and this is our cost of goods sold in the month of April. Objective number 2, calculate the reorder point. So we have here our keywords. Reorder point refers to the time when items must be replenished to avoid being out of stock. Then our lead time here refers to the number of days the ordered items will be delivered. Daily usage refers to the average number of units a company uses or sells in a day. And safety stock refers to the extra stock preserved to minimize risk of shortfall in the existing stocks. Example number 3, a furniture company uses 300 board feet of wood daily. It takes 3 days for a new order of woods to be delivered. The company maintains a safety stock of 1,000 board feet of wood. Determine the reorder point for the wood. So this is our solution. The formula is reorder point equals daily usage times lead time plus safety stock. So for our daily usage, it's 300. So times the lead time, so it takes 3 days for new orders to arrive. And then we have the safety stock here, 1,000 board feet. So 300 times 3 plus 1,000 equals 1,900 board feet. So this is our reorder point. Example number 4. An oil company sells 7,500 liters of oil daily. Any order will take 7 days to be delivered. The company's safety stock is 3 times its daily sales. Calculate the reorder point. Reorder point equals daily usage times lead time plus safety stock. So our daily usage here is 7,500 and our lead time is 7 days. It takes 7 days for the new order to be delivered. And then the safety stock here is 3 times its daily usage. So daily usage is 7,500 times 3. Now 7,500 times 7 equals 52,500, while 7,500 times 3 equals 22,500. Adding 52,500 plus 22,500, that is equal to 75,000 liters. So this is our reorder point. Objective number 3, calculate the ordering cost of inventory. Our keyword here is ordering cost, so that includes the cost of procuring inventory, cost of purchase, and salary of employees involved in preparing the orders, among other expenses. Example number 5. A construction company issues 14 purchase orders of sacks of cement a month. The estimated monthly costs of issuing purchase orders are 60% of the company's employee cost of $5,200, $20 per hour for 8 hours for handling the incoming stocks, 14% of the overhead cost of $1,050. Question: what is the average monthly cost of issuing a purchase order? So first, we are going to find 60% of employee cost. So that's 5,200 times 0.60, and that is equal to 3,120. Then we have the handling cost. That's $20 per hour for 8 hours. So that's 20 times 8. That is equal to 160. Then we have 14% of overhead cost. Overhead cost here is 1,050, so that's 1,050 times 0.14, and that is equal to 147. Then adding these three amounts up, so we have 3,120 plus 160 plus 147, so that is equal to 3,427. We are asked to find the average monthly cost, so there were 14 purchase orders. So that means 3,427 divided by 14, that is equal to $244.79. Objective number 4, calculate the carrying cost of inventory. We have here our keyword carrying cost include all the cost of maintaining the inventory unit it used or sold. Examples are depreciation costs, salaries of employees assigned in maintaining the inventory, and others. Example number 6. A company that retails oils issues 24 stock orders of stainless barrels monthly. Its estimated monthly cost of keeping the inventory are employee salaries $21,200, damaged inventory, that is $1,468. Then we have 15% of overhead cost of $5,238. Determine the total carrying cost of the inventory, and then determine the average monthly carrying cost per stock order. So for our solution, we are going to list down all expenses in carrying the inventory. So we have here employee salaries $21,200, damaged inventory we have here $1,468. Then we have 15% of overhead cost. Overhead cost here is $5,238, so that's 5,238 times 0.15, and that is equal to 785.70. Then adding these amounts up, we have this sum. So our answer here is $23,453.70. Now how about the average monthly carrying cost per stock order? So because there are 24 stock orders, so we will divide this amount by 24. So that's 23,453.70 divided by 24, and our answer is 977.24. Objective number 5, calculate the net sales, cost of goods sold, gross profit, and net income. So we have here our keywords. Net sales refer to the sales after deducting the returns, damaged or missing goods, and the sales discount. Cost of goods sold refers to the direct cost in the production of goods sold, cost of materials used in the production of the goods sold, and the labor costs. Then gross profit refers to the difference between the net sales and the total cost of goods sold. And we have here additional keywords. Net profit or loss refers to the difference between the gross profit and the total operating expenses. So if the total operating expenses is greater than the gross profit, it will be a net loss. Then we have here operating expenses or the overhead. These are expenses related to the operation of the business, such as salaries and wages, office rent, supplies, utility bills, and others. Example number 7. The total sales of RRR Construction Company in July amounted to $23,784.02. During the month, defective goods returned totaled $695.24. Determine the company's net sales in the month of July. So this is our solution. The formula is net sales equals total sales minus sales returns. So we have here our total sales, 23,784.02. Then we have here sales returns, $695.24. Then the difference between these two amounts is $23,088.78. So this is our company's net sales. Example number 8. At the end of the year 2021, SSS Shipping Company's income statement showed the following information. Total sales, we have $2,436.98. Sales returns, $46,802.21. Cost of goods sold, we have $1,674,000.33. Question, determine the net sales and then calculate the gross profit. Now for our solution, the formula for net sales is total sales minus sales returns. So the total sales we have here is $2,436.98, then minus sales returns, $46,802.21. The difference between the two amounts is $1,953,634.77. So this is the net sales. Now, for our gross profit, our formula is gross profit equals net sales minus cost of goods sold. So this is our net sales. The cost of goods sold here is $1,674,000.33. And the difference between these two amounts is $279,364.44. This is our gross profit. Example number 9. ABCD Merchandising Company's income statement in the month of July showed the following information. Net sales, $165,320.45. Cost of goods sold, $98,823.11. Salaries and wages, $36,204. Utility bills, $2,654.28. Office supplies, $3,568.26. Question, determine the following. Gross profit, total operating expenses, and net profit. For our gross profit, this is our formula, net sales minus cost of goods sold. Our net sales here is $165,320.45, and our cost of goods sold is $98,823.11. The difference between these two amounts is $66,497.34. So this is our gross profit. And for our total operating expenses, so we have here the salaries and wages, then utility bills and office supplies. So we have these amounts, $36,204 for salaries and wages, then we have $2,654.28 for utility bills, and $3,568.26 for our office supplies. The sum of these three amounts is $42,426.54. So this is our total operating expenses. Now for our net profit, the formula is gross profit minus operating expenses. So the gross profit we obtained was $66,497.34, and we have the operating expenses $42,426.54. The difference between these two amounts is $24,070.80. So this is our net profit. Objective number 6. Calculate the total assets, liabilities, and equity. These are our keywords. Current assets are assets that can be readily converted into cash within a year. Examples, supplies, etc. Long-term assets are assets that cannot be readily converted into cash within a year. Examples, buildings, equipment, etc. Current liabilities are liabilities that are due within a year. Examples, accounts payable, short-term loans, etc. Long-term liabilities are liabilities due after 1 year, and equity represents the amount of capital contributed by the owners of a business. Example number 10. At the end of the year 2021, the assets of CCC Merchandising Company are cash $45,679.21, supplies $12,223.94, merchandise $89,345.18, accounts receivable $46,230.04, equipment $103,348.12, building $623,450. Then determine the following: current assets, long-term assets, and total assets. For our current assets, it's cash plus supplies plus merchandise plus accounts receivable. So the amount for cash is 45,679.21 plus supplies 12,223.94 plus merchandise, that's 89,345.18, then plus accounts receivable, that's 46,230.04. The sum of these four amounts is 193,478.37. So this is the current assets. For long-term assets, we have the equipment and the building. So for our equipment, we have 103,348.12. And then for our building, we have 623,450. So the sum of these two amounts is 726,798.12. So this is our long-term assets. Then for our total assets, it's the current assets plus the long-term assets. So we already found current assets, that was 193,478.37, and we also found the long-term assets, so that's 726,798.12. The sum of the two amounts is 920,276.49. So this is our total assets. Example number 11. In the third quarter of 2021, the liabilities of DDT Steel Corporation are accounts payable $76,341, 3 months loan $20,000, 2 years loan from PQR Bank, that's $42,500, then 5 years loan from RST Lending Investor, that's $60,600. Determine the following: A. Current liabilities, B. Long-term liabilities, and C. Total liabilities. So for our current liabilities, we have accounts payable and 3 months loan. So that means we have 76,341 plus 20,000. The sum of these two amounts is 96,341. So this is the current liabilities. For our long-term liabilities, we have 2 years loan from PQR Bank and 5 years loan from RST Lending Investor. And the amounts are 42,500 and 60,600. The sum of these two amounts is $103,100. So this is our long-term liabilities. For our total liabilities, it's equal to the current liabilities plus long-term liabilities. Our current liabilities was 96,341, and then we have the long-term liabilities 103,100. The sum of these two amounts is $199,441. So this is our total liabilities. Example number 12. In the first quarter of 2022, the assets of SSS Shipping Company are cash $103,340.21, accounts receivable $89,432.16, supplies $24,230.23, equipment $234,400. Its liabilities during the period are accounts payable $14,763.23, 6 months loan $20,220, 4 years loan $32,000. Determine the equity of the company. First, we are going to find the total assets. So these are the assets: the cash, accounts receivable, supplies, equipment. The sum of these four amounts is $451,402.60. Then we are going to find the total liabilities. So the liabilities are accounts payable, 6 months loan, 4 years loan. These are the amounts, and the sum of these three amounts is $66,983.23. Now for our equity, the formula is total assets minus total liabilities. So we already computed the total assets. That was $451,402.60, and the total liabilities was $66,983.23. The difference between these two amounts is $384,419.37. So this is the equity of the company. Thanks for watching, guys. This is Teacher Regil. Keep safe.